Welcome, everyone, to our 2026 Economic Outlook. My name is Haleh Moddasser. I'm managing partner at Stearns Financial Group, and I'm joined today by Stephanie Link, CNBC contributor and Chief Investment Strategist at Hightower Advisors. Thanks for joining us, Stephanie.
Thanks for having me, Holly. Happy New Year.
Thank you, you too.
Thanks.
And we're also joined by PJ Williams. PJ is our Chief Investment Officer at Stearns Financial Group. Thank you for joining us, PJ. I look forward to hearing what you have to say about client portfolios. So let's get started, Stephanie. To say that 2025 was a busy year would be the understatement of the year. And yet it appears, despite all the noise out there, geopolitics, everything else, we ended the year with the S&P up 18% and international up in the over 30%. So talk to us a little bit about 2025, maybe just a brief overview, because we really want to focus today on 2026, your outlook and investment themes.
Sure. And again, it's great to be here. Thank you for having me. I think 2025 was a good year. As you mentioned, up 18%. And a lot of that is because the economy grew faster than what most people expected. And the economy grew much faster than expected, where we started off slow in the first half of the year, 1-2% growth. We then had a third quarter number of GDP of 4.8%. And I track this wonky thing called the Atlanta Fed Tracker. All it is it's a real-time look at what growth is. They just throw in all kinds of data points and then just kind of real-time tells you what growth is. It is not accurate. It's just a direction. And we are running at 5.3% for the fourth
Wow.
quarter.
Wow.
So we went from low singles to mid singles. The trend is about 2% growth for the economy. So why did we grow faster than expected? We grew faster than expected because the consumer remained resilient, because they have jobs, and because they're spending. And the consumer is 70% of the economy. Yes, it's K-shaped, because I know you're going to ask me that.
I'm going to ask you that.
It's almost always K-shaped, but I'm going to talk about 2026 and why I think that's going to change. But it's K-shaped, okay, but the consumer is spending, and that is a very nice, that was a very nice tailwind for the economy. The second, no question about it, it's all about AI and the growth in AI, not just Mag 7, but the entire food chain that gets impacted from AI. AI gets spent by Mag 7 and others, and then you need to build out the infrastructure, data centers, grid, and then you need power. And by the way, we are underpowered. We haven't upgraded the grid in 50 years. And data centers, we don't have enough of them. So all of that led to better growth. Why do we care about growth? Because it feeds directly into earnings. And earnings grew last year about 15%. Now the long-term average is 5. We grew 15. Okay, that's just 2025. I will say this. The setup for 26 is a little more challenging from an S&P 500 total return basis. Why do I say that? Because you've now had 3 consecutive years of tremendous growth in the markets. 18% last year, 23% the year before, 24% the year before. The long-term average is 7.7% in the S&P 500 total return. That's not to say that we can't continue to see a nice market in 2026, but we've had a lot of good news. And I think I'd be happy with about 10% for 2026 because I think the fundamentals still bleed over into 2026. But I think the composition might look a little bit different, where we are starting to see a broadening out, not just Mag 7 running the show. 2 years ago, the Mag 7 accounted for 90% of the returns. I think this year is the year where maybe Mag 7 do okay. They should, because the earnings will be good. But I think you're starting to see a broadening out. And the reason I think that is because I think this growth in GDP will continue. And if you believe that, then you want to own more cyclical companies, companies that are tied directly to better economic growth. What does that mean? That means financials, materials, industrials, energy, all should do well. I would say even beyond gold and silver, everyone talks about that, asks a lot of different questions about the materials and the precious metals. You're seeing copper, palladium, platinum. So I think you're seeing a broadening out to start the year, and I think there's more to come.
So, Stephanie, I'm not gonna try to throw you a curveball, but I do meet with clients regularly.
Yeah.
We live in a pretty progressive part of the state, and even though I give this advice to my clients, I'm gonna ask you the same question. They come in, they're super stressed about geopolitics. I tell them they have to divorce geopolitics from fundamentals, but many people think at some point there could be a convergence. Is that a wild card for you in 2026?
2026, there's a lot to worry about, if you will. Geopolitical issues are certainly one of them. The Fed is certainly one of them. The fact that we have been a concentrated market, does it revert to a concentrated market? Valuations are elevated. So, in other words, I worry about a lot of things. Holly, you know me by now. I worry when I don't worry because that
I
means,
know you
right?
do.
That means I'm complacent. And the market always climbs a wall of worry. I will say this about geopolitics. While it's very unsettling, and there's a lot of moving parts right now, I've never made money trading around or investing around geopolitics, meaning something happens, the market falls 500 points or whatever it is. I've never made money selling on geopolitics.
Right,
I've
right.
never, I have made money buying the dip, buying the uncertainty if some stocks or some ETFs or whatever it is, if the valuations look more attractive to me, I care the most about the US economy. That's why I started off with why did we do so well? Because if the economy can continue to grow mid-single digit growth, which is not a foregone conclusion, and by the way, it is not consensus. I think it will. And I think that is the most important thing for profits. My good friend Larry Kudlow taught me 18 years ago, stocks follow profits on the way
Yeah,
up and on the way down. And there will be shocks along the way. Geopolitics absolutely will create shocks. But you should, while it's really unnerving, kind of keep focused. Focus on what you can learn about companies, about what's going on in the economy, and about where we are in the business cycle, just fundamentals.
yeah,
In a stressful environment where geopolitics takes the market down, sometimes they will throw everything out. Everything will go down, right? Even the number one company in any industry, that's where you want to actually look to buy.
yeah.
Or the number one
Especially with
company.
these stretched valuations that we have. I mean, it could be just a great buying opportunity, right?
100%. Again, based on what you think the economy is going to do, and there's a lot of tailwinds why in 2026 we will see continued growth. And it has everything to do with, I say, consumer AI, but it also has to do with no matter, I know we'll probably get into this, no matter what new Fed chair we have, they're going to be likely more dovish. Okay. So rates are probably more favorable. I don't know if we're going to get three cuts. In fact, I don't think we are. Maybe we get one, maybe, but you're going to have a dovish Fed chair that starts in the spring. Um, and you have companies that have been getting more productive. So here's an interesting stat I learned last week. Last quarter, the data is a little stale, but it just will show you productivity rose 4.9% in the third quarter. And unit labor costs were down 1.9%. That is the definition of Goldilocks. That means productivity means we're growing. Unit labor cost means, and it's down negative, it means we're not seeing huge labor inflation. That is good for corporate profits,
Is
right?
that the result of AI?
Absolutely, 100%. And I think I haven't seen a 4.9% productivity number. Holly, I haven't seen one. I have to go back decades.
Wow,
So
that's incredible.
it really is. And that's why it was an eye opener. Now, is it going to stay 4.9%? I don't know, but we have a revolution in AI. It is not a bubble by any means. Are the stocks priced to perfection? Some of them are, sure. But as I mentioned, you have this whole food chain. So many industries are benefiting from this, and so many industries and CEOs are saying they can't keep up with demand. So it is real. It is helping our economy, and I think into 2026, it is going to help be the tailwind, continue to be the tailwind. And again, I do think the consumer will stay strong. And why I think you may start to see a little bit of a difference in the K-shaped economy is if we can get housing to
Yeah.
recover, because we're growing 5% plus without even a housing cycle. So we know the wealthy folks have homes, and we know that they've participated in the equity markets. The wealth effect of the upper end consumer since 2019 is at $60 trillion. Now, the low end has not participated. Unfortunately, that is usually the case. That typically is, unfortunately. But I think what the administration is trying to do is if we can get somehow, some way, interest rates to come down and the 30-year mortgage to fall into the fives versus the sixes,
Yeah, huge. The biggest
then
boon for the middle class and lower classes would be being
and
able to buy a home, right?
and they because they don't have the same wealth effect as the upper end.
Right.
So I
Right.
think that's what they're trying to do. And I just think that that's a very interesting, like I think that's a really we talk about themes all the time. I think that's a big, big theme, not only housing recovering, but it working and getting it to be, it's never going to be uniform, this economy. It never will, but at least to help the
Right.
affordability.
Just even some of the other things like potentially capping credit card interest rates and these kinds of things that would help people get through this period.
I think I don't think that's going to happen, but I think he's trying.
He's trying.
I think they're the administration, they're trying to do various look what they're doing with Fannie Mae and Freddie Mac, making them buy $200 billion in mortgages. So that to me, like they'll just keep figuring out stuff, whether it works, it doesn't work, but they're trying. And I think that that is something worth watching because I do believe that the housing market, there is such an enormous pent-up demand.
Yeah,
We're 5 million homes short in this country. 5 million millennials want to buy a first-time home. And
exactly.
so,
It's not just lower income people, it's young people who
yeah,
are delaying family formation and all the other things that you do when you grow up, right? Buy a house,
exactly.
have a baby.
Oh, well, that's a perfect point, actually. So housing, it's only about 10% of the economy, but the multiplier effect to what you exactly just said, Holly, is well, when you buy a home, you got to buy stuff in the home. You have to buy stuff
Yeah,
outside the home. You have to buy a car to get from the home to wherever you got to go. Maybe it's to
exactly.
go build out a data center. Who knows, right? But it's all of this. And that's why it's so incredibly important. And we have a president that is a real estate person. He knows the
Yeah.
real estate market. So I think that that might be the nuance that changes this year. We'll see. It's going to be a long time in the coming, but for the most part, we do have a favorable consumer. We're a nation of spenders, Holly. You and I both can attest to that. But whether people have the money or not, we continue to spend. And yesterday we had a retail sales report that came out. Retail sales last month alone grew 4%. People are spending.
Their spending, it's remarkable because we hear so much negative press around
Oh,
people not being able to afford things. Looking at the macro picture, we're doing pretty well.
100%. I got to tell you, it's the biggest pushback I get when I talk to clients, advisors. I'm sure you do too. They're like, wait, what? The consumer is doing well? I'm like, yeah. I mean, it again, yeah, it's K-shaped. And that's what they'll say. It's K-shaped. Okay, I get it. That's not the distribution we want. However, it's what we have, and those that have the money are spending.
Yeah,
And that's the important point. Consumer is 70% of the economy, and then also services is a spend on services from the consumer is 75% of consumption. What does that even mean? That means more people are going to restaurants, on airplanes, in hotels, just going on cruises, going outside, going to concerts. And that has been the trend post COVID, but it has stayed really resilient.
we've bounced back completely on
Oh yeah.
that sector since
Yes.
COVID.
Yes.
Yeah,
But it
yeah, yeah,
remains very strong and it continues to be a tailwind. And
yeah,
so
yeah.
that is what it is.
Well, so I love how bullish you are. I'm going to switch over to PJ and see. PJ, do you agree? Do you have concerns? What's your thought?
Yeah, I think we definitely agree with a lot of what Stephanie said. Really thinking about corporate earnings and the consumer being the two driving forces as we go into 2026. They drove 2025. I think a stat I heard you say, Stephanie, in your internal outlook was that since 1926, I think we've had four times where we've had 3 years of 15+% returns in the market.
Yes.
And we heard you say earlier they think we can do 10% again. That might surprise people.
Yeah.
But in three of those four scenarios that we've seen historically, that next year was at least 10%. And so just because we've had 3 good years in a row, that alone says nothing about what's going to happen in 2026. We really want to look at earnings. And when you think about it, I think you mentioned that 15% is kind of the projected earnings for a year, earnings growth for the year. That'd be 6 consecutive years of earnings growth. We don't always see that. And so the consumer's doing well, earnings are growing. And what does that mean? That even though we're at high valuations in the market, we can support that. If you look at where we were at the end of 24 to where we ended 25, a 18% year in the S&P, the 4P ratio barely moved. It moved up just slightly. And that's because of corporate earnings growth. So if we see that again, you can continue to see the stock market follow those earnings, as you mentioned. I think our concern is the consumer if something derails it. Everything's looking good right now. And like you said, it's K-shaped, and we'd like to close that gap. But as long as the higher earners continue to spend, we're going to continue to see corporate earnings growth along with operating margins being at all-time highs. We've never seen operating margins where they're at. So companies are in good shape. What could derail that consumer? Obviously, an exogenous event that we're not talking about today. Or if you saw an uptick in unemployment among white-collar workers. We've gone from 3.4% low back in April 23 to where we are today, around 4.4%. So still a really healthy labor market, but we are seeing some signs of it slowing down. And so that's something that would concern us. Obviously, if you mentioned a Fed misstep combined with something that generates a lot of inflation that gets us back mid threes, even to the fours, that we think could be a headwind to the markets and spook investors. But overall, I think we agree with you that coming into this year, things are set up pretty well. You mentioned geopolitics. I think that's one of the things that freaks our clients out the most. Obviously, there's a political divide in this country, and depending on how you view the world events, you might have different feelings. But when we think about what we see in typical geopolitical events, we tell our clients it's typically noise, might be a short-term effect on the markets, but generally, there's very few market-moving long-term events. When you think about the war in Ukraine, the war between in Gaza, you think about what happened in Venezuela. Those are all humanitarian crises. We hope they get dealt with. But in terms of long-term affecting the markets, we're not seeing that. The oil discussion with Venezuela, it's going to take years or decades to fund the infrastructure if you can find the funding to get it back online that might, alter the price of oil significantly. Obviously, the Middle East is something we're focused on. If something did happen there that changed the oil output and where it was going, that could be a big game changer. And obviously, China, Taiwan's always on people's minds, but we're not anticipating anything happening this year with regards to that. But something could happen in the future, and that could be a little bit more material in terms of how do we get semiconductor access at the same rate and level that we have now if exports got shut off out of Taiwan. Not things we're expecting to happen this year. And so again, I think on the whole, we very much agree with Stephanie that things are looking good coming into 2026.
And let's just
Excellent.
say one thing, PJ. It sounds like you would agree with this. The labor market is cooling for sure. But if we look at and there's so many different metrics of looking at the labor market. Everyone wants to focus on the non-farm payroll report. That's backward looking. I don't even pay attention to it, to be honest with you. And there's so many revisions, it's inconsistent. If you look at the weekly jobless claims, now, I don't want this audience to go and look at weekly jobless claims. Let PJ and I do that on a regular basis, but we smooth it out, right? Because it's volatile, any weekly data. So I go back a month to 3 months to 6 months and average it all together to see what weekly claims, initial jobless claims are. And yesterday we had such an interesting number. For the week, we were below 200,000, which was the lowest in quite some time. And then you smooth it out for a 4-week moving average, you're at 205,000 jobless claims. That's the lowest in 2 years. So just for perspective, during the last 5 years, the smoothed out version of weekly claims was the average 273,000. So I just mentioned we're at 205. And during recessions, that number usually gets to 350 to 375,000 weekly claims. We're nowhere near a recession. Now, all that being said, there's other data points we hear from companies. What's going on is there's no hiring, but there's no firing.
Yeah.
And we get job opening data all the time, once a month. And actually, this past month, the quit rates went higher. When people quit a job, it means they have another job that they're ready to go to, and there's more, they feel better about the availability. And the quit rate has actually been going higher. So I actually think the labor market concerns are overdone. Again, cooling, but not collapsing. There's one job available per one unemployed person in this country. That's pretty healthy too. So we can all look at all the various different data points, but I feel very strongly that that's the reason the consumer will continue to spend because when they have jobs, when they have 4% wage growth, when they have inflation that, yes, it's sticky, but it's certainly down quite a bit from 9% in 2022, they will spend. And so that's a real big part of the confidence factor that I have in the consumer.
Well, that is a perfect segue, I think, into your major investment themes for 2026, Stephanie.
Yeah, well, for sure, it is absolutely the consumer, and it is absolutely the discretionary piece. We touched on housing. I believe it's probably one of the most under-owned, I would say, sectors or themes out there right now because we do need lower interest rates. But as I mentioned, we are 5 million homes short in this country. And I think that it won't take much if we can get interest rates below 6%. So I like housing. I like the consumer. I like services because the consumer continues to spend. But there's a couple of other themes, and you and I've talked about this, Holly, a lot over the years, and I've been talking about it for over the years, and it's not going to surprise anyone because I already touched a little bit on it, but it leads me to my third theme. But my second theme is AI, data center, building out the grid, and power. I would much rather own the industrial companies that will help build all this stuff out. There's a company called Eaton Corp, and they just give out stats. That's why I like to listen to what they say. Do you know that um, we haven't spent on incremental dollars on the grid in over 50 years, and 75% of the grid is over 25 years old. So
How
if
did we
you
get
believe,
there?
isn't
How
that
does that happen?
Oh, well, it's all about the government and it's all about, priorities and that sort of thing. But the grid is a real problem. But also data centers. I know everyone's talking about data centers. We only have 11,000 data centers in this world. We have to get to 30,000. So if you believe in AI, which we all do probably, you need the data centers, you need to upgrade the grid, and you need the power. And there's not enough power. That's why we're hearing about nuclear and wind and renewables and natural gas. We have a ton of natural gas. We just don't have the pipes to get from where the natural gas is being produced to where it's needed. So there's a lot of bottlenecks going on, and it's a huge, huge theme. And again, I get asked all the time, is it a bubble? That's the reason it's not a bubble, is because of this enormous spend. Now, why I mention all that is because AI, if you believe it's a huge theme, cybersecurity is even bigger. And it's because of AI that cybersecurity is even bigger, right? AI
Yeah.
is not secure. So I have a stat for you guys, and I just learned it actually. Um, we have many companies that are now starting to use AI for coding instead of people.
Mm.
And Robinhood, Coinbase, Microsoft, and Google all are spending 30 to 50% more on AI coding than they have been. So they're not using humans, and that's even more dangerous. But most importantly, we have 4,000 companies in the world that are in cybersecurity, public and private. And I think you're going to see massive consolidation. I think the big five companies are going to get bigger and bigger because not one company, not even the very best company in the world in cybersecurity, offers a one-stop shop for their customers. Nobody has the whole thing. So you're seeing massive consolidation already. Clients don't want 20 vendors. They maybe want 5 to 7. So that is a huge, in my mind, a huge theme that is, look, these stocks some of them have done well, but some of them took a pause last year. And so you can own the top five, that's what I would recommend, or you can own an ETF. There's plenty of ETFs out there that are a little less volatile because these stocks can be really pretty volatile. But I think that that's really an amazing opportunity. I mentioned briefly the rotation into energy. Energy has really been a dud for the last 3 years. You haven't had to pay attention to energy, myself included. I did not, but they too will benefit from the power needs as well. Number two, they will benefit from faster global growth because not only is the US growing better than trend, around the world, the growth is also improving. And that is because around the world, we've seen global central bankers have very, very easy policies, lowering interest rates, providing all kinds of fiscal policies. And so they too are growing a little bit better. And so when you have faster global growth, you need more energy. We have a more disciplined OPEC plus as well. And onshoring here in the US, well, the depletion rates are actually accelerating. So I agree with PJ. I think that Venezuela is going to take years before us to figure that whole thing out. I don't need Venezuela to work for the energy stocks to do well, and they're very, very cheap. I'll just give you a couple more real quick one-liners. Automation and robotics is in the second inning. Quantum computing, this is more of a 28, 29 kind of a theme, but think of quantum computing as AI on steroids. And it's more safe and it's more secure, but they think it's a $100 billion total addressable market. I mentioned international real briefly. I've recently bought the ETF in Brazil. Interestingly enough, I just spent the holidays there, and their country is booming, and they too have a new government in place. Again, fiscal monetary policies are easy. They're growing GDP at 3 to 4%. They also, if you believe in kind of the commodity cycle improving, which I think will do, remember we talked about the global growth, and so you're seeing commodity prices accelerate. Well, they do a lot in terms of mining and industrial manufacturing, and also they have some pretty amazing banks in their country as well. And so that ETF that I bought had a whole bunch of that in it. And just speaking of commodities, if you believe that you need the data center, you need the grid. If you believe in my housing story, then you need copper because copper is the one thing that goes into all of these things. And so we have seen copper do really well this year. And then over the last year, I think copper will continue to do well. Just two more quick ones. Animal health. I always say this because I have my Peter Lynch hat on. Peter Lynch was a wonderful, successful portfolio manager at Fidelity. And he used to say, and he's written many books, and I highly recommend them all. He used to say, invest in what you know, invest in what you do, invest in what you see. I have benefited greatly from that in watching my 18-year-old. That being said, I have 3 pets, a dog and 2 cats, and I spend more on them than I do on my 18-year-old. So, and I'll bet you a lot of people that will listen to this will agree to that, right? So, it's a total addressable market. It's $50 billion. It's going to $200 billion by 2030. And there's really only 3 companies that are participating, public companies anyway. And then lastly, I would say women investing. There is the U.S.
Last but not least, can I say that?
Definitely not least for sure. But I say this, it's a fairly new theme. And I will say that the US wealth transfers, and Holly, you know these stats better than I, $128 trillion between now and 2048. And women are going to inherit 70% of that total. That's $47 trillion. Now, we can focus on a lot. There's a lot of, by the way, ETFs that focus on women and promoting women and women in the C-suite. And there are all kinds of companies. And I strongly like those ideas that women that are gaining relevance in the overall business world. There are more women in the C-suite than ever before at 24% of the companies in the S&P 500. That's up from 17% a decade ago. 24%, I'm not satisfied with that. And I
No,
know
but it is an improvement. The stat that blows my mind, Stephanie, is in 5 years, boomer women will inherit $30 trillion.
a lot. It's a
That
lot.
that that that's a lot of money. And so companies that are not just led by women, but focused on things women care about, whether
Absolutely.
it's women's health, whether it's cosmetics, I mean, whatever it is, healthcare, it's women will have enormous spending power. I mean, they already control the majority of the nation's wealth, something people don't like to talk about, but it's true.
It's 100% true. And we could take it a step further of there's a lot of ways to play this theme. And yeah, right, not just in the C-suite, there's a lot of ways to play it. But I think it's also education. And
Yeah.
it helping to do education for women in investing, in understanding. More women are going to college, more women are going to graduate school than ever before. More women are getting more in the know. Fun stat, last year, 30% of women bought themselves diamonds. How about
Yeah.
that? I was one of them, and I am married.
And I was one of them too, I must admit.
See, there you go. There you
And
go.
I did it for myself because I could. You know?
Of course, it makes you feel good, but you're right. The spending power is going to be enormous. It already is enormous, but it is going to be even more so. And there's a lot of ways to play it in the marketplace, but it's just also an understanding and an appreciation of what's to come. And it's just something to keep your mind open to.
Yeah, and I'm super excited because I know Stearns Financial and Hightower specifically is super focused on educating women investors. Women generally kind of shy away from that, especially boomer women. And so,
Oh yeah.
really, as they inherit this wealth, we feel like it's kind of incumbent upon us to help them understand it, not be intimidated by it, to own it, to invest it, to grow it. And so I know that Hightower is sponsoring an event with CNBC for women. I'm super excited about that. If you could tell us a little bit.
Yeah, so on May 28th, we're going to do an event for women in investing. It's going to be called Women in Wealth. And it will be myself and three other women contributors. We're going to do kind of like a round robin, if you will, in a variety of different rooms. And we're going to talk a lot about various different parts of investing, of just how to handle your wealth and how to build it, and how not to be afraid of it, to your point. And these are some of the smartest women I know in the business. And CNBC has graciously decided to help us sponsor it. It will be at the NASDAQ. The CEO of NASDAQ will be there as well. So there'll be a lot of wonderful people to meet. And it's really for Hightower advisors that are women, their prospects, their clients, as well as other people that want to learn more. And I suggested this to CNBC because I learned in so many meetings with advisor practices that do just women events, like yourself, that women really do want to learn. They really haven't, for whatever reason, they haven't taken the reins over in terms of investments. And some of them are going to inherit money, but some of them just want to learn more as more sophisticated they get.
And they're also different from male investors. They
Oh,
have
yeah.
different goals. I mean, their
Yes.
women generally are not chasing alpha by
Yes.
itself. They're chasing financial security and
Yeah.
legacy. And so just helping, they're more holistic in their investment views. And so I think it's really important that the industry starts to shift a little bit toward meeting women where they are.
I think that is so spot on. And no one knows it better than you because you're at the front line of all of this and you're
I
talking
try.
to
I
them.
believe in it and I believe in the women. They're amazing.
I know. And super
Um,
smart and super smart. And they ask questions. I have found smaller groups, they ask more questions than bigger groups. But the bigger groups, what always happens once the panel is over, then they come and they want to talk one-on-one and that sort of thing. And that, whatever way you want to do it, it doesn't, there's no
yeah,
right or wrong way. It's the way you feel comfortable.
yeah. Um, Speaking of women and most investors, our clients at Stearns, I mean, I know you focus, Stephanie, specifically on the stock market, the public stock market.
Sure.
Would you agree that for most clients who've inherited wealth or are retiring, that, being in 100% stock portfolio probably doesn't make sense in terms of an overall allocation.
No, absolute 100%, 100%. What's interesting about this though is you remember a couple of years ago, Barron's came out with the 60/40 asset allocation portfolio is dead. Okay, that we knew was a top, as we often make fun of Barron's. I love the people at Barron's, but sometimes they glom on and 60/40 portfolio last year did quite well.
It
So
did.
right? I mean, and that was a big surprise that fixed income actually grew. I mean, that is something. So I leave the allocation decisions to you, to PJ, to the teams, but I will say it depends on what your time frame is, what your risk profile is. You want to have a combination. Do you want to have maybe a little less of 60% or a little less of 40% and 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 have a little bit exposure to private markets? That's okay. I personally would not do more than 5%, but that's me. Some people in we have some advisors that do 10, 20, 30. I know what I am comfortable. But it's like for many years when we had zero interest rates, there was no alternative. Everybody had to go into equities and looking for yield at the very least. Now there are so many alternatives out there.
Yeah, bonds are getting to be, I mean, they're much more attractive. Even real estate now, it's a
Oh,
good buy
sure.
time in real
Yeah.
estate. So, PJ, I'm going to shift over to you because I know we have mostly retired clients who aren't earning an income. And it's amazing how differently you view your portfolio when you don't have an income coming in. So, the
Oh,
volatility can be terrifying to people.
yeah.
What are we doing to protect our clients?
And I think it's really where are we finding opportunities or seeing opportunities potentially in client portfolios? I mean, I'd agree with a lot of what Stephanie said. We're going to say we would recommend a higher percentage allocation, but it matters on your risk tolerance, it matters on your liquidity needs,
Yeah.
it matters on each individual client having their own unique profile and working with their advisor to make sure their allocation makes sense for them. I'll start first off talking about our public equity exposure. We've talked a lot about today about fundamentals broadening out for the 493 stocks in the S&P that are not the Mag 7. And so we don't have a full allocation in our equity portfolios to Mag 7. It's more of a broad, diversified exposure. We think that coming into 26, their earnings growth is going to look a lot closer to the Mag 7 than it has in recent years, where the gap has been so wide, as the Mag 7 have driven most of the earnings and the growth in the S&P. But when we're thinking about how we build a portfolio that's diversified outside of just the public equities, we're thinking about putting 10 to 20% of client portfolios in private credit, private equity, a theme that I know Stephanie likes a lot that she's talked about today, private infrastructure and private real estate. And again, depending on your risk tolerance, maybe more in the private equity slash infrastructure for more aggressive clients,
Mhm.
more in the real estate infrastructure, and maybe private real estate might be turning around finally. It's been a rough few years in the real estate area. I'm just going to comment quickly on each of these, and then Holly's going to talk about a series that we have coming up. We're going to do deep dives on these different verticals within private market assets. But when you think about private credit, a lot of people have been reading the headlines a lot lately about all the money flowing into it, all the new funds starting up. There's been some high-profile defaults lately. That's mostly in the direct lending space. Private credit encompasses a much larger world, trying to fill a void that's been left by the banks, but it could include infrastructure or energy lending, it could include commercial real estate lending, specialty finance. And so private credit is not just direct lending to corporations. Private equity, there's a stat that everybody's been quoting lately that 80 to 90% of companies in the US with greater than $100 million in revenue are private. And so your opportunity set is much larger in the private space than it is in the public space. So we think having a little allocation, calling it 4 to 6% maybe, to private equity to complement your public equity exposure, which is still going to dominate the risk assets in your portfolio, makes sense. Within infrastructure, we talked a lot about it today. We talked mostly about the data need, the power need. There's also a transportation need. We talked about toll roads, airports, seaports. They're all aging, and there's not going to be enough financing or government money coming into the space to adequately make up for the gap we've fallen behind in the last couple of decades. And so, along with the AI boom and needing more energy and more data centers, et cetera, we think there's opportunity there. And then within real estate, office obviously fell off a cliff during COVID. We then saw a few good, really strong years of multifamily. They struggled the last few years, and really that's supply coming online that started out when interest rates were low, and they can get cheap financing back in 2021 and 22. And then now we think we're going into a period that might offer some opportunity back into multifamily because the supply hasn't come online or is not planning to come online because projects were stopped or abandoned or postponed with high inflation, higher financing costs, et cetera, higher labor costs. And so we think there could be an opportunity there. Again, all the investments we're talking about here today are going to be diversified and they're going to complement that traditional portfolio of 60/40, 75/25, whatever your risk tolerance is, taking just a piece of those assets, a little bit from equities, a little bit from bonds, and putting it into these other areas we think can complement the public market assets.
Yeah, so just to clarify, we've always had some private alternatives available to some of our higher net worth clients. In the old days, you had to be a qualified purchaser, 5 million or more in investable assets, excluding your home equity. So they were less approachable for a lot of our clients, but these products have become a lot more democratized. So you can go into these things with as little as $25,000. And so in this past year, for the first time ever, we have put all four of those asset classes in the private space into our model portfolios. So that's a new thing. And because this is new for our clients, we are having a series this year of webinars that are going to do a deep dive, as PJ mentioned. So stay tuned. We're going to start with private credit, which there's been a lot of headline news around, and you'll get information, clients, on that. But I think that it's going to be very informative. Again, if you have any thoughts or questions, don't hesitate to reach out to your advisor. But this is kind of across the board in our model portfolios at this point.
Mm.
So, any closing thoughts, Stephanie, PJ, before we sign off here today?
No, I mean, I think we covered a lot. I think one thing I would like to leave you all with is that the reason I think very much about thematic investing is because no matter if we have a booming economy or we have a recession or we just have malaise in the marketplaces, if you believe in the total addressable markets and the growth and the longevity of them, that's why that it doesn't matter what the economy is going to do. And so what I do is think big picture, then I think themes, and then for me as an equity portfolio manager, then I look at stocks. You could look at private companies like PJ mentioned. He's talking about privates on in terms of data center and power and grid and AI and that sort of thing. I'm doing it on the public side. I just don't think that it matters what the macro does for these really, really revolutionary ideas in terms of the themes that we talked about.
Yeah, and you're spoken like a true woman investor, which you have the long-term view in mind. And I think that's what you're saying is this is the direction we're going in. So, stay the course, stay disciplined. If you believe in the sector, it will
Yeah.
work out ultimately, right?
100%. 100%.
Well, thank you. I think this concludes our 2026 outlook. Stephanie, thank you so much for joining us. PJ, thank you. And of course, thank you so much to our clients for joining us today. Again, don't hesitate to reach out with any thoughts or questions. Thank you.
Thank you.
Thank you.